Hey everyone, and welcome back to the Better Podcast, where we break down the ideas, strategies, and real world decisions behind thoughtful real estate investing in the Triangle. If you've been following along with our summer case study series, you know we've been pulling back the curtain on real better projects and walking through the thinking behind them. The goal of this series is simple: to show you not just what we build, but how we think about opportunities, evaluate risk, and make decisions before a project ever gets off the ground. So today, we're continuing the series with another project that offers a different set of challenges, opportunities, and lessons. Today, we're going to put a spotlight on our development at 1614 Alcott. Some words in the past that we've used to describe projects include efficiency, simplicity, opportunity, but one phrase that really comes to mind with this project is conviction, and you'll see why when we start talking about it. So, Devin, why don't you just tell us a little bit about the project?
Yeah, this is just a very simple, straightforward deal where we were splitting off two small lots from an existing lot. We'll get into some of the details on why that was amazing and easy, and basically why we were so strong in our assumptions and had that conviction that you just talked about to go and, hey, we can subdivide this, sell the front house with, minimal work, and then have these two lots free and clear that we want to own 10, 20, 30, 40, 50 years from now.
Yeah. I mean, and so like the way we found it was also pretty interesting. I mean, there was a realtor we've worked with in the past. And, we've spoken about on a couple of our podcasts that sometimes it's difficult for other people like wholesalers or realtors to find deals for us because we specifically know what we're looking for. But this realtor happens to be someone, who's sophisticated, has worked with us, knows what to look for. And although he's not perfect in terms of being able to locate good deals for us, he knew that this was a really good opportunity for us specifically.
Yeah. And he went to the seller and told them, hey, these guys know what they're doing. When they put an offer out, it's going to happen. We actually were willing to pay more than we paid for this property. We put in a lower offer, obviously, than what we were willing to pay out the gate. And they basically came to us and said, we're going to put it on the market. And ultimately, what that ended up not working out great for them. We actually paid less than, we were like, okay, well, we're willing to pay at least $200 for this thing. We came out at 180. They went to 190, didn't get an offer. And, we were like, okay, 190 gets it done. When they came back to us, we're like, cool, we saved $10,000. So yeah, they had poor timing too with some other things that were happening, geopolitical around the world a couple months ago. Whereas for us, like we talk about having conviction for a 10-year hold, we're very comfortable with this deal. We don't really care about the price of oil 6 months from now. We know 10 years from now, this is a good deal. And that's how we knew we wanted to do this transaction.
Yeah, I mean, we've spoken about relationships on our previous episode here as being like the key word there. And although conviction is the key word here, relationships was one of the main reasons that we were able to close this deal, because we worked with a realtor who knew that we would close, who knew that we were trustworthy, who knew that we could, fund the deal and get everything done in time. And so that was the driver for us being able to, I guess, get picked. I think there were other offers on this one at a similar price, right? And he kind of went to bat for us and said, we can close. And we did.
Yeah, we were known as a bird in the hand.
That's right. And then as far as the deal itself, right, generally speaking, we look for three reasons, right? Good reasons to say yes to our deals. Because saying, oh, it's in a good neighborhood, that's not enough, right? Just because something's in a good neighborhood. So let's just kind of talk about these three reasons why we said yes to this one.
Yeah, I mean, number one on pretty much all of our deals is location, location, location. I mean, that's why they say it 3 times. So like this area, it's south of the highway, really close to downtown. You can walk to Duke Park. We love that you can walk to one of the best parks in Durham. So that's, as far as demand, there is always demand in a location like this. And so it takes away some liquidity risk if you need it. There's also ease of finding a tenant because everybody wants to be 5 minutes from downtown. Additionally, we have a leverageable asset here because of the existing house. We weren't tearing it down and we're still able to create our lots. And we knew, hey, maybe we don't want to own this house, but we want to own this land. What are the odds we could do some quick repairs to this house, get it back on the market, and at least get our money back? And so by being able to do that, most likely, we'll find out in a month or two, but we will, worst case, have minimal cash in on the 2 lots. Best case, have these 2 lots free and clear and some cash in our hand, which is actually our expectation. I'm optimistic here based on what the property looks like today. And last, there was some simplicity on this site plan. We already have our subdivision done, and we don't have the house on the market on the existing house yet. And that was possible because we just were able to throw something out there prior to even closing, and knowing that we had an ability to go from 1 lot to 3 lots really quickly, have our build envelope for the design we want. And there are just no questions. There's no shared driveway. It's just super simple. And that was possible largely because we had double frontage. And when I say double frontage, I mean the backyard of the existing house had street frontage on it, where we were able to remove parts of that backyard and just have street frontage on another street rather than on Alcott Street. And that's why we talk about Colonial, because the new lots are actually on Colonial.
Yeah. So just to recap that, first on all of our deals, as you said, it's the location, right? Always making sure it's in a good location. We do a lot of work in A neighborhoods, but we also like B and C neighborhoods as long as we find something that makes it a worthwhile neighborhood to invest in. Second, being able to leverage the existing house. I think on a lot of our deals that we do, sometimes we just demolish a house so we can put more houses there, create more housing for the people of Durham and of Raleigh. And that's great. But there is an advantage to doing a deal where there's already a house there and you can increase the value a little bit through a rehab, just because of the way that lenders collateralize an existing house versus land, right? They can lend more on that. And so it allows us to come more out of pocket. So that was the second thing. And then the third thing that you were mentioning was double frontage, and giving us not only a superior layout, the site layout because of that double frontage, but the ease of getting to that site layout, right?
Yeah, we saved brain power and time on the site layout.
Yeah. And of course, speaking of timing is a huge component of returns. Every investor knows that. It's not just about how much money goes in and how much money comes out, but exactly when that money comes in and out. And so the timeline here pretty much aligns with most of our built to rent deals, right?
Yeah, and it's lining up pretty perfectly on this one too. We're about to hit the market, which means we'll be selling in 45, 60, 90 days tops. At the same time, we just have our design being in its finalized draft, which means it'll go off to engineering and doing plot plans and the like, so that we'll have permits in those 2 to 3 months from now also. And then breaking ground later this year on a 6 or 7 month build really puts us on the market to rent next summer, which is ideal for the seasonality of the Durham market. So we feel really good about that. We can go very quickly, and with new construction, we can even refinance before we even have a lease in hand. So
yeah. So zooming out here, the way, and I think we talked about this a lot on our podcast on the Chamberlain, right? The way we usually like to do these is, if there's a rehab on the front end, we can usually do the rehab concurrently with any sort of subdivision, design, engineering. And so that time frame is usually, let's call it 3 to 5 months, depending on how complex it is, how backed up the city is, et cetera. But generally speaking, we like to get the house rehabbed and sold in 4 months, and then by that time have permits in hand to start building. And then 6-month build approximately, depending on how much we're building. It could be a little bit more, it could be a little bit less. And then obviously leaving a few months to either sell it if it's a build to sale, or to rent it out and refinance it. So generally speaking, we look to get all of that done within 12 months. We, of course, give ourselves extra time. We look for 15 or 18-month loans on the front end to make sure that we have ample time and we're not rushed. And, just in case something goes wrong, you always want to be conservative. But 12 months, money in, money out is our goal.
Yeah, this one fits that almost to the T. We actually have 2 loans that are going to happen here. The first loan, 12 months. I mean, we're easily going to crush that, 3 to 4 months into that. And then we get a new loan when we go to do the vertical construction. We have 12 months from then to get our refi done. Like, we're going to hit that mark.
Okay. So let's talk about the first loan, because I think the way we structure this deal on the financial side is the way we're going to structure, all of our deals is there's really 2 distinct stages, right? We talked about the rehab and the development, and then we talked about the construction and either the sale or the lease up. So on the front end, right, we have the development side. Talk a little bit about what our money looked like there.
Yeah, we were able to get credit for lots in this case. And so we both got a large loan size based on the loan to value because they gave us credit for the lots. And additionally, since there was an existing house, they're willing to do what a lot of lenders are willing to do on the hard money side is go to 85, 90% of purchase price and then fund all of the rehab. And so ultimately, for something like this, to just even get that first stage through, you really only need $30,000 to $40,000, including the interest reserve and things like that to do a project like this.
Okay. So from our side, because, we funded the development stage ourselves, we have plenty of people that, like funding development with us, and we welcome that. But generally speaking, with such a small cost, it's really easy to just get this done ourselves. So we came out of pocket $40,000. Where does that leave us on the back end once we sell the house and once we have lots in hand.
Yeah, once you sell the house at that rate, we pay off all the debt and we actually have the lots free and clear in this case, unless we get a little bit lower, but then we're coming to the table. We'll probably fund again out of pocket to give us flexibility on how we do stage 2. I can't imagine us coming out of pocket another $10,000. And so if you think about that, you've just put in $50,000 and in 4 months, and that's your worst case, you put in $50,000 and in 4 months, you have 2 lots free and clear.
Okay. And so you have the 2 lots free and clear. And like, if we're going to go forward and fund this second part ourselves, right, we can just kind of roll that through and take a down payment, take an initial disbursement from the lender to start building. But let's say we were going to sort of separate these hard. Right. So what do returns look like just thinking about the first stage?
Yeah, just thinking about the first stage, I mean, you're almost doubling your money if things go to plan. If you're being conservative, it's still more like a 30-40% return in a fraction of a year. At least on paper, you're obviously left with lots, which then you would have to liquidate in some manner or, like what we like to do, which is roll them right into a development project to get them cash flowing within a year.
Yeah.
And compound the return.
Yeah. So just on paper, right? It's essentially somewhere between 70 to 100% returns in somewhere between 4 and 6 months. We don't need to calculate an IRR for you to know that that's really good, right? And that's why we do the development side of this project. Like, it takes a normal project, a normal just build, and it just makes it more appealing. And we've always talked about how you can't find lots in Durham and Raleigh anymore just on the market. People know what they have. They know what the returns on land is. And so they don't sell it at a price that makes sense for builders. And so that's what sort of led us to resort to the idea of let's just create our own land. And now you can kind of see why we do that.
Yeah, there are so many people who want to live in a place like Duke Park that the homeowners will bid up because it's worth more to them than to a builder in a typical situation.
Yeah. So on the build side, you kind of talked about there's not really much capital needed for that. Additionally, we already have that capital. So what kind of returns do we get on that built to rent side?
Yeah, I mean, we're again just compounding into that. If we think about I like to think about this similar to our Cherry Grove situation where we took 70,000 value of lot and turned it into over 100,000 in 12 months and had a stable cash flow. And in that case, we immediately had an arbitrager taking over the lease, paying that debt off over 30 years after taking our $70,000 worth of lot and getting another, 50% return on that in 12 months.
Yeah. So the returns are good here. I mean, obviously it's tough comparing returns just building and then renting out to returns, development projects, so to speak, right? But I think the difference here is risk. It's pretty low risk, right? But it's not super low risk to do the development work, right? There's some risk that comes with that. But on the build to rent side, where we are. We're okay with these smaller returns that are still in the mid to high teens, right? 15 to 20% returns on a build to rent project is amazing, but the risk is so low here.
And when I said the 50%, that's on paper. And we get that over time. There's some other things that could happen here, appreciation, rent increases, things of that nature. And also it's a very tax efficient 15+% that you get there because once you have that structure, you're deducting it also.
Yeah. Yeah, it makes a lot of sense. And so part of the reason the risk is so low, especially on this built to rent side, is because of our access to comps here, right? We have comparables that we have from the past, from past work that we've done. And we also know that we're getting a little bit of benefit from being in what is technically Duke Park neighborhood, even though the house itself wasn't really priced like it was in Duke Park.
Yeah, and this exact design has been appraised multiple times for us at this point. And on the low end, we've gotten $420,000 in East Durham on, C Neighborhood Street. And we've actually seen the house we built in Colonial Village that appraised for over $500,000. So we're pretty confident in the range here. We went a little bit conservative, when we were thinking about this, that we can make this thing worth $450,000. We're pretty confident in that. We just had an appraisal on Cherry Grove, which was a similar duplex at $460,000. So we're confident in that risk. And then we also have a lot of rental comps. And especially at that sort of mark of, 1,450, 1,500, there are just so many 2-bedrooms that show that. And we obviously have Cherry Grove. We have the Colonial Village duplex there too. So we're comfortable with that risk and know that these units flow well when we go and construct them and that people will want to live in them.
Yeah. I mean, I don't think we specifically talked about what we're building, but in some regards, we've become a little bit known for this small lot duplex that we continue to throw at places because every time we put it up, not only does it appraise well, it rents well and people are happy with it. And the quality is good. And the layout is actually quite nice when there are 2 units that are 600 square feet and 2 bedrooms each.
Yeah, and honestly, like people don't really know, like your tenants, they don't really know what the square footage means. They just know how the space feels when they're in it. And so when you tell people this is a 600 square foot 2-bedroom unit, they're like, you're crazy, you're out of your mind. And it's like, no, come inside and then you tell me what you think the square footage is. And people are more like, hey, this is an 800 plus square foot unit. They really can't tell the difference. And we're able to put these on 2,000 square foot lots minimum. So the strategy is proven.
As far as the people that rent it, right? I mean, they're not necessarily like, it's not necessarily 2 people sleeping in 2 separate bedrooms. I mean, sometimes you get someone who wants an office, right? Like maybe it's a couple and they want an office, or maybe they want a separate space, like a bonus room. And so it's competitive with other 1 bedrooms of a smaller size in other places. You get a second bedroom here and you're not in an apartment building.
Yeah, exactly. And we know at this location, you're like close to the highway, but not right next to the highway. People like that easy access to transit. And again, like we mentioned, 5-minute drive to downtown. It's hard to beat that if you want to be close to downtown.
Exactly. So let's pull up the design here. And by design, I mean site design. Right? Let's talk a little bit about what this actually looks like and why it was so easy. And I think the key here is double frontage.
Yeah. When you look at that, we basically had over 5,000 square foot lot that we were looking at. We know we can split this up easily, create a driveway, which means we don't have to do a shared driveway and still fit our basic envelope. We, rough justice, know like, hey, we can build one of these duplexes with a 25 by 28 envelope. We check our setbacks, make sure our height works too for what the city's going to allow height wise, and we're good to go. And it's literally that simple in this case, compared to some other situations where you start talking about shared driveways, flag lots, things of that nature. You can run into some hangups. You have to talk things through with the city. So we also ask one basic question whenever we're chopping off the backyard of a house, like, is there a cost associated with that to the existing house? And here, it was so minimal, we think it's zero because it was land that wasn't being used. And quite frankly, we actually improved the backyard space from what it was before because we cleaned it up. We added mulch and pine straw, put up a privacy fence, and actually, because of the double frontage, have zero loss on that backyard.
Yeah. So, I mean, of course, there's still a flag lot, but I think you were referring to there's no flag lot on the existing house. Right. So we're instead of being on Alcott, right, we're facing Colonial, and then there's a house that's right up front, and then there's a flag lot that comes around back. And I think that's important because if you position the front house, as close to the front as you possibly can, and you position the back house further, as far back as you possibly can, there's like ample space, not only for just like livability, right, but parking there. And I think it doesn't feel like you're really flagging it. It feels like you have 2 separate houses here.
Yeah, and there's a difference between single family and duplex when you talk about flag lots. Our single family is not associated with the flag lot here in this situation. Exactly. And with a duplex, you have somebody who is already sharing a wall with somebody else. They expect another person's car to be driving in and out at times that is, they wouldn't be driving their car. So they're more open to the concept of a flag lot and sharing some parking space.
Okay, so what you're saying is if you have a single family house and you're a family, you want that privacy. That's why you bought this house. And so having that flag lot intrudes on the privacy sometimes, but from the duplex perspective, you already are kind of giving up part of your privacy by sharing a wall. So this actually has minimal impact.
Yeah. And some of that's the difference between a homeowner buying and a tenant also.
Yeah. Yeah, that makes sense. Okay, so we're not done with this, right? The house is listed or about to be listed, and we're selling off the existing house. So, like, what's kind of the status?
Yeah, we have our subdivision. We're going to be going off to engineering to then apply for permits soon. That should hopefully line up well timing-wise with when we sell this house. As of the recording, we're going live on this listing tomorrow. We're going to do a final walkthrough today. Ian and I will check it out and be like, okay, looks like it did a week ago, just to make sure. We're good to go. We'll go live, and by the time this is, actually being listened to by people, hopefully we have the property under contract with a 45-day close, something like that, and that will be ready to go into phase 2.
Yeah. I mean, we're making our predictions, right? A lot of what we're saying about returns are, the money hasn't come back in our pocket yet, but when we think about appraisals we've gotten, not only on this project, right? We've already gotten appraisals on lots here way above what we thought they would be. And, we have data from comparable sales and all of this stuff. So even though it hasn't sold, like we do have a good basis for this, we're making our predictions, right? They're still predictions. So I guess once once the house sells and the lots are split up and we start building, we'll kind of loop back around and we'll tell you like, hey, check it out. We kind of knew what we were talking about here.
Yeah, exactly. And, for phase 2, we already have our capital raised because it's just again, simplicity. We can on the front end explain this. We also we know with pretty high confidence that these lots are going to appraise for phase 2 because of how high they appraise. They could appraise for half of what they appraised for in phase 1, and we still are good to go into phase 2. So we feel really good about that and just the overall profitability of this project. And, that goes back to our level of conviction when we signed it and why we're even willing to talk about it right now in the middle of the project, because things are happening exactly as we thought they would so far on this project. And other people who are looking at this in the market that had the opportunity that first weekend before we snagged it, maybe didn't have the conviction because they were worried about what oil was going to be doing over the next 6 to 12 months.
Yeah. As I said, we funded this one, but we do a lot of projects like this, build to rent projects, especially recently, as Devin's kind of talking about, with things being so uncertain from geopolitically, and there's more space for the rental here with the uncertainty in the sale market. We're looking for, we have deals upcoming and we're looking for investors for those deals as well and for future deals. So maybe a little bit bigger than this deal, which is nice. There's just more to go around on those. We'd love to have people there. Check out some of our other opportunities on the website and stuff like that.
Yeah, and reach out to us in general if you want to be on the front end to talk to us before we do phase 1 on one of these projects.
Yeah, as far as how you can contact us and how you can reach us, we have a bunch of events that we host. Very specifically, once a quarter, we do something called Coffee and a Case Study, where we have coffee, talk a little bit about it, and then we dive into some development case studies that we do, kind of like this, but more longer form. Give updates on all of our projects so people know where we're at. We love to have our investors there, but we also love people who are curious. That'll be happening the Friday, September 11th. So come by at that. We'll be at the Durham Food Hall, and we'll be talking about this. Other than that, there's social media, there's other in-person events, there's our bi-weekly email and stuff like that.
Yep, please reach out. We love talking about this stuff. If you genuinely have curiosity and just want to learn, we'll talk to you about it also. We're happy to spread the knowledge that we have.
Well, thanks for talking to us here and listen, and we'll see you in the next one.